Your Excellencies, distinguished guests, ladies and gentlemen, good morning and welcome to the 2024 Bank of Korea International Conference. My name is Yong Kim from the International Affairs Department of the Bank of Korea, and I'll be your MC for this two-day conference. It is an honor to host this conference attended by prestigious delegates representing their countries or organizations. The Bank of Korea International Conference has traditionally been where prestigious guests exchange insights on policies and challenges and share thoughts and ideas on current economic issues. This conference is attended by numerous eminent scholars as well as policymakers from international organizations and central banks around the world. Especially this year, the active participation of central bank governors from Europe and the Asia-Pacific region, as well as senior officials from international organizations, has allowed us to prepare a more enriching conference program. This year's conference will focus on various topics centering on the theme of the evolution of natural interest rate and its implication of the global economy. And I'd like to take a moment to introduce and extend our gratitude to the mastermind behind this conference, Professor Thomas Sargent, whose expertise and guidance have been instrumental in shaping the conference's agenda and focus. Thomas Sargent, the William R. Buckley Professor of Economics and Business at New York University since 2002, received the Nobel Prize in Economics in 2011 for his groundbreaking research and cause and effect in the macroeconomy. Since 2007, he has played a crucial role as an organizer for our conference, contributing his expertise and leadership. His dedication and hard work have been instrumental in bringing us all together for this enriching conference. Please join me in thanking him for his outstanding efforts. Thank you. So now let us begin the 2024 Bank of Korea International Conference. Before the main session begins, we will have a keynote speech on the natural rate of interest as a reference point for monetary policy, a practitioner's view. It is my great privilege and joy to introduce the Honorable Thomas Jordan, Chairman of the Governing Board of the Swiss National Bank. Before we bring him up on stage, I would like to give a brief introduction about him. Thomas Jordan received his PhD in economics from the University of Bern in 1993 and joined the SNB in 1997. He became a lecturer in 1998 and an honorary professor in 2003 at the University of Bern, and received an honorary doctorate from the University of Basel in 2017. Jordan was appointed to the SNB's governing board in 2007, became vice chairman in 2010, and chairman in 2012. He's actively involved in many international organizations as governor of the IMF for Switzerland, a member of the BIS Board of Directors, and chair of the FSB's SCBR. So without further ado, please welcome him with a big round of applause.
Ladies and gentlemen, I am delighted to be here today in Seoul to address such a distinguished audience. I would like to thank Governor Rhee for inviting me to give this keynote speech. The topic of this year's Bank of Korea International Conference, the evolution of the natural interest rate and its implications for the global economy, could not have come at a better time. Monetary tightening over the past 2 years has lifted policy rates and longer-term interest rates from their historical lows. There are reasons to believe that some of the structural drivers of real interest rates have also changed direction in recent years. A lively debate has emerged on whether real interest rates will return to their pre-pandemic levels or whether they will remain higher because the natural rate of interest, R star, has increased. Over the past years, R star has become an important reference point for monetary policy. The difference between the real interest rate and R star gives a measure of a central bank's monetary policy stance. Therefore, R star estimates help in evaluating different monetary policy options. However, the measurement of R star is subject to high uncertainty. Today, I would like to focus mainly on how policymakers can nevertheless make use of R star estimates in practice. In the first part of my remarks, I will briefly review the developments in real interest rates over the past decades. I will then turn to the concept of R star itself. In the second part, I will discuss how policymakers can use R star in practice to assess the monetary policy stance, and in particular, how they can deal with the inherent uncertainty in R star estimates. Here I will draw especially on the Swiss National Bank's experience. Let me begin by looking at the long-term trends in the real interest rates. Real interest rates have declined considerably in most countries over recent decades. In chart 1, you see next slide, please. Yeah. We see a decline in long-term interest rates, real interest rates in South Korea, Switzerland, and shown in gray in a number of other advanced economies over the past 30 years. Real interest rates fell from around 4% in the 1990s to slightly below 0% in the decade after the global financial crisis. What can explain this global downward trend? In essence, it points to a decline in R star and can be attributed to drivers that have increased the supply of savings or decreased the demand for investments over time. The drivers which have received most attention in the literature relate to lower potential growth, higher retirement savings, and greater demand for safe assets. Over the past 2 years, real interest rates have risen back to a level slightly above zero. This mainly reflects the tightening of monetary policy in many countries, but at the same time raises the question of whether R star has increased again. Indeed, the outlook for the structural drivers of real interest rates is mixed. Factors such as low potential growth or increasing life expectancy suggest that real interest rates may remain low. However, there are other factors that could potentially lead to a persistent rise. These include lower savings due to a growing proportion of the inactive population, large fiscal deficits, a productivity boost from new technologies, and substantial investment in the green transition. In my view, it is still too early to judge whether a reversal of the global downward trend in the real interest rates is already taking place. Nevertheless, it's very important for policymakers to follow this development closely. Indeed, analyzing the structural drivers is necessary to better understand the outlook for R star. I'm looking forward to the discussions at this conference, which promise to deepen our understanding of this important question. Let me now turn to the role of R star as a reference point for monetary policy. Now, what is a useful characterization of R star from the perspective of monetary policy? R star can be interpreted as the real interest rate at which a central bank's monetary policy stance is neither accommodative nor restrictive. In particular, it is the rate that is consistent with stable inflation and the closed output gap in the medium term. The term was already coined at the end of the 19th century. Since the 1990s, however, it has experienced a renaissance, in part because most central banks have moved to an implementation framework centered on steering short-term interest rates. Like other equilibrium concepts, such as potential output or the equilibrium exchange rate, R star is unobserved and has to be estimated. Empirical estimates of R star should satisfy the following requirements. R star estimates should be unaffected by cyclical and short-term movements in economic aggregates, and they should not depend on monetary policy, reflecting the principle of the long-run neutrality of money. Thus, R star should only reflect real and longer-term, that is, structural changes in the economy. At the SNB, we use a wide range of models to estimate R star. Some focus on potential growth as the determinant of R star, while others distinguish between domestic and international factors that affect us R star. We also use financial market expectations of real interest rates in the long run as a measure of R star. In chart 2, please next chart, we see a range of estimates from these models for Switzerland. The downward trend of R star in Switzerland is similar to that in other countries. The range was fairly narrow before the COVID-19 pandemic. Since the pandemic, however, it has widened. R star estimates are subject to considerable uncertainty. Let me highlight two sources of this. The first is uncertainty about the right model. Chart 2 shows us that the estimates from the models can differ substantially at times. The second is the statistical uncertainty surrounding the estimates of a specific model. This is evident from the occasionally wide statistical confidence spans around point estimates. The uncertainty surrounding R star complicates their use in the monetary policy process. Nevertheless, neglecting R star in practical monetary policy considerations would be a mistake. Therefore, I would like to address the question as to how monetary policy makers can deal with the uncertainty surrounding R star in practice. I will first discuss how to arrive at a measure that can be employed usefully in the monetary policy process despite the uncertainty. I will then explain how both our monetary policy framework and our risk management approach help us deal with uncertainty. Now, given the substantial statistical uncertainty surrounding R star, it is important to arrive at a robust assessment that can then be used for monetary policy making. Let me call this the policy-relevant R star estimate. What are the requirements for such an estimate? It cannot simply be a mechanical average of all available model estimates. Rather, it must be based on expert judgment. On the one hand, it should reflect the broadest possible agreement among our model estimates. On the other hand, it should also take into account information from outside these models, such as an assessment of structural drivers of real interest rates that cannot be adequately captured in R star models. Furthermore, a realistic assessment of the distribution of risks surrounding the policy-relevant R star estimate is also important. Let me discuss these aspects in more detail. Our portfolio approach of different R star models is crucial for arriving at a policy-relevant R-star estimate. It allows us to take account of alternative macroeconomic models as well as different estimation methods. The portfolio approach also protects against the risk that individual R-star models could at times give false assessment. In a first step, a sound understanding of the various structural drivers of R-star in individual models helps in judging the plausibility of these estimates. Uncertainty about R-star can be narrowed down by using expert judgment to select only the most plausible models and to discount models deemed less reliable in certain situations. Let me give you a recent example where we applied expert judgment to discount information from individual R-star models. As is well documented, extraordinarily large swings in macroeconomic data during the early part of the COVID-19 pandemic caused strong fluctuations in R-star estimates in variants of R-star models introduced by Laubach and Williams. Our analysis showed that we should discount these models during this episode. Now, in a second step to arriving at a policy-relevant R-star estimate, we apply a robust statistical measures, such as a median, to the range of model estimates selected in the first step. This filters out some of the unsystematic variation that a few outliers may cause. An additional crucial step on the way to the policy-relevant R-star estimate is to cross-check the results of the second step against a broader set of indicators. For instance, an environment where real interest rates have been low or falling, but where inflation remains subdued and no output boom has been observed, suggests a low value of R-star. The years following the global financial crisis are a good example. During this period, real interest rates fell to historic lows in many economies, and in Switzerland they even moved into negative territory. Nevertheless, inflation remained low, and we did not observe an output boom in Switzerland. This gave us confidence in the assessment that R-star must have fallen in line with our estimates. Finally, for monetary policy consideration, it is also important to have a good assessment of the uncertainty around our estimates of the policy-relevant R-star. We need to understand which side we are more likely erring on and why. Again, a good grasp of the structural drivers of R-star is vital for assessing the uncertainty. So, what is the role of this policy-relevant R-star estimate in our monetary policy process? First, it is an important element in the assessment of current monetary conditions. With regard to interest rates, monetary policy is restrictive if real interest rates are above R-star, and it is expansionary if they are below R-star. However, other factors, such as real exchange rate, also play an important part in our assessment. Second, the deviation of real interest rates from R-star is essential for our inflation forecast and thus for gauging medium-term inflationary pressure. While the policy-relevant R-star estimate is important for assessing the absolute degree of monetary tightness, it is necessary to emphasize that changes in monetary conditions from one quarter to the next may be assessed more or less independently of potential changes in R-star. The definition of R-star as a long-run equilibrium value implies that it's typically slow-moving. Therefore, quarter-on-quarter changes in monetary conditions can be assessed simply by looking at the change in the real interest rate. Given its important role in monetary policy decisions, how should we communicate about R-star? In the light of the high uncertainty surrounding these estimates, publishing a precise number could be misleading. At the same time, publishing a relatively wide range for R star could give the false impression that we have only a very limited information about our monetary policy stance. It should also be kept in mind that R star is just one element in monetary conditions. They are also influenced by exchange rates, a broader set of interest rates, and other factors. Nevertheless, transparent communication can often be useful, including regarding R star. Therefore, we regularly communicate our views about longer-term developments in real interest rates in speeches and news conferences, in particular when there are more fundamental changes in our assessment. Uncertainty surrounding the policy-relevant R star estimate can be narrowed down to some extent, but it cannot be completely eliminated. Let me now discuss how we deal with the remaining uncertainty by using a risk management approach. The risk management approach acknowledges uncertainty and prescribes that a monetary policy decision should be suitable for a range of scenarios. It is therefore important to have a good characterization of all likely scenarios. In the specific case of R star uncertainty, a good understanding of the implication of policy mistakes for the inflation outlook is crucial. An overestimation of R star may constitute a downward risk for the inflation forecast for a given interest rate path. And conversely, an underestimation may constitute an upward risk for the inflation forecast. The costs and benefits of different policy options have to be evaluated for all plausible inflation paths. The monetary policy decision should then seek to achieve our objective of price stability for a broad range of possible scenarios. Our most recent monetary policy assessment in March, when we lowered the S&P policy rate by 25 basis points to 1.5%, offers a good example. In chart 3, next chart please, we see that our latest conditional inflation forecast puts medium-term inflation at around 1%. The possibility that R star may have increased represents an upward risk to this inflation outlook. Two considerations are important here. First, how likely is this scenario? Our view was that the risk of an underestimation of R star was limited. And second, would our decision to cut the S&P policy rate would still yield an acceptable result if R star was higher than currently thought? The answer was yes. We judged that even with a somewhat higher R star, our inflation forecast would remain within our medium-term price stability range. Moreover, if upward risk to inflation were to materialize, this would be most likely associated with a weaker Swiss franc, which we could counteract by selling foreign exchange. In summary, a risk management approach is essential for central banks to handle uncertainty effectively. Ultimately, our decisions are guided by our mandate of ensuring price stability. Before concluding, let me briefly review how the S&P's definition of price stability in our monetary policy strategy also helps us to deal with uncertainty, including that related to R star. In our monetary policy strategy, we define price stability as a rise in consumer prices of less than 2% per year. Deflation, that is to say a sustained decrease in the price level, also breaches the objective of price stability. We do not have a point target for inflation, and thus we do not seek to achieve a specific value between 0 and 2%. Furthermore, we focus on the medium-term inflation outlook, which means that negative inflation or inflation in excess of 2% can temporarily be tolerated. This definition allows us to respond flexibly to external shocks and to weigh up the costs and benefits of alternative monetary policy measures. As a small, open economy, Switzerland is highly exposed to disruptions from abroad. Our definition of price stability as a range rather than a point target also helps in dealing with uncertainty related to R star. Let me illustrate this by returning to our most recent monetary policy decision. As shown in chart 3, our latest conditional inflation forecast sees inflation between 1 and 1.5%. This is based on the assumption of a constant S&P policy rate of 1.5% over the entire forecasting horizon. It also takes into account our estimate that R star is around 0%. There are currently reasons to believe that R star has increased somewhat or might rise over the coming years. We view this as a small upward risk to our inflation forecast. If this risk were to materialize, our monetary policy stance would be more accommodative than intended. This will lead to somewhat higher inflation in the medium term than currently projected. Since we can let inflation fluctuate within the range of price stability, the current monetary policy would most likely still be compatible with price stability even if R star was slightly higher. Thus, with the price stability defined in terms of a range for inflation, we have more time to properly evaluate potential changes in R star. To summarize, our definition of price stability means that a wider range of inflation outcomes is acceptable. This also makes small errors in our judgment about R star or other factors affecting the inflation outlook less problematic. By comparison, a point target allows much less flexibility for dealing with this uncertainty. Of course, this does not mean that the wider the range for price stability, the better the results. There is a clear trade-off. A wider range allows more flexibility for monetary policy, whereas a narrow range tends to provide a better anchoring for inflation expectations. In Switzerland, our experience shows that a price stability range of between 0 and 2% for inflation has worked well in this regard. Ladies and gentlemen, let me conclude. The natural rate of interest, or R star, is an important reference point for assessing monetary policy. However, R star is unobserved and has to be estimated from the data. These estimates are subject to uncertainty, at times substantially so. Nevertheless, neglecting R star estimates in practical monetary policy consideration would be a mistake. What can central banks do in practice to deal with this uncertainty? At the S&P, an important task of our economists is to transform uncertain model estimates into an R star measure useful for monetary policy making. This policy-relevant R star estimate plays an important role in our monetary policy decisions. And with our risk management approach to monetary policy making, we ensure that our decisions are appropriate for a range of scenarios. A good understanding of the fundamental drivers of R star is important in this respect. To this end, we draw on work from researchers, both at central banks and academia. I'm very much looking forward to interesting presentations and discussions of this highly relevant topic in this conference. Thank you very much for your attention.
Thank you very much, Chairman Jordan, for giving us an insightful speech. Once again, please give him a warm round of applause. Chairman Jordan, please take your seat on the stage for the next policy dialogue. Now we will begin the policy dialogue. Governor Rhee, we are honored to have you lead the policy dialogue. I now invite you to take the stage.
Oops, this microphone is working. Okay. Thomas, welcome to Bank of Korea, and I'm quite impressed not only by your high quality speech, but also the Swiss precision. You just ended exactly at 9:30. Okay. Let me ask two questions regarding your speech, and then I probably ask a few others before I open the question to the floor. As you said, R-Star is a very academic concept, hard to communicate, but we cannot avoid using it in our monetary policy framework. And as a practitioner, I'm very interested in your speech about how you derive the policy-relevant R-Star in Switzerland. Why don't I explain what we are doing in Korea? And then if you, based on your way, if you can suggest how we can improve, it'll be really nice. So basically, we also have like 4 or 5 models of estimating R-Star. And instead of trying to get a one policy-relevant R-Star level, we use the range and then compare whether our real interest rate is upper part of the range or the lower part of the range to judge whether our monetary policy, our monetary policy stands. And in doing so, definitely we sometimes discount some model over the others, like as you mentioned. And we also check whether our judgment is correct by using several other measures, such as we look at our core inflation movement, whether it has a downward trend that indicate that probably our interest rate is above part of the R-Star. And then we also use some other indicators as financial condition index and others. One problem we have is whenever we try to introduce some global factors, such as exchange rate, current account, capital mobility, or movement, we find that the model estimate fluctuate quite a lot. So probably tomorrow, one of our staff will present a model which incorporate external sectors more, but this issue is still not resolved, and we find that whenever we try to incorporate fall-in variables, as you mentioned, the estimates change quite a lot, which make us hard to use it. And lastly, we also, not only the price stability, our mandate also is to look at the financial stability. So we always trying to get an estimate, R-Star estimate, in consideration of finance stability too. And we usually find that that level of R-Star is slightly above the R-Star when you just look at the price stability. So these are the kind of quick summary of what we are doing it. So can you suggest how we can improve further?
Well, Chang, I think this is very difficult to give you some advice. It's complete, research strategy, and it looks quite similar to the one that we are applying. I think it's important not only for communication, but rather for the internal discussion to have a clear view about the equilibrium in the economy. So do we have a closed outlook gap? Is the exchange rate close to the equilibrium? And is the interest rate or the real interest close to equilibrium? And this then defines also the discussion that we have in the governing board at the Swiss National Bank to figure out whether our monetary policy stance is adequate or not. And it's really the task of the economists to come from an uncertain world to something that is then usable for a structured discussion at the board level. And I think this is important. We know that it's a lot of uncertainty, but this should not be an excuse not to have a clear view, more or less, what is or where we believe is the most likely equilibrium. It's even much more difficult with the exchange rate. There we have much more fluctuations, and also the exchange rate equilibrium changes a lot. So we have different interest rates between countries. We have also different trade developments, and they can change a lot. There it's even more difficult. But nevertheless, we try to figure out whether the Swiss franc is rather highly valued, fairly valued, or undervalued, because this is important for our judgment about the policy stance.
So when you actually estimate the policy-relevant R-Star, you have to assume some level of exchange rate as equilibrium, or you just compare these two variables
Yeah.
simultaneously?
Well, we try to separate that in a way. So it's more monetary conditions in a very simple way is the sum of the deviation of R from R star and from the exchange rate from the equilibrium exchange rate. So the sum of the two mainly then reflects the stance of monetary policy. But well, there may be some interaction between the two, but we try to estimate them separately. No.
And my second question is that at the end of your speech, you mentioned that some flexibility in your monetary policy stance helps to manage the risk from underestimating or overestimating the R star. And you mentioned that I find actually two differences of your system and ours. You mentioned that you are targeting range of inflation 0 to 2% rather than point target. And also you mentioned in your slide that when you actually calculate the future path of inflation, you assume that that path is based on the assumption that interest rate remain at your policy rate over the horizon of this forecast. On the other hand, we have a point estimate, point target, 2% of inflation, but we also allow flexibility by saying that this point target is a medium-term goal rather than short-term, so you can have some room to deviate. On the other hand, when you actually project the inflation path, we are using implied model consistent implied interest rate, even though we do not publish it on outside. So, what's the main motivation to use the fixed interest rate for over the horizon? I'm asking this question because Bernanke's recent report to the UK is not a good idea to use the market, rate. But also, is there any reason that you use a fixed interest rate in your forecast?
Yeah. Well, the main reason is that we would like to give some information about future monetary policy decisions, but we do not publish an interest rate path. Okay. So it's neither market rates nor our own view about future interest rates. But by publishing an inflation forecast under the assumption of unchanged interest rates, depending on the slope of the inflation forecast, you can figure out whether rather a tightening or a loosening is necessary in order to maintain inflation within the range of price stability or bring it back into the range of price stability. The other point, I think the key difference between having a range or having a point target with some flexibilities, that we can accept an inflation rate for quite a long time that may be at 0.5 or at 1.9. So depending on the economic circumstances globally, and because we are a small open economy and we are really exposed to these international shocks, we can then decide on a cost-benefit analysis whether it makes sense to accept a low inflation but positive inflation rate and rather not lower rates further but accept a low inflation rate, or whether we should fight that and bring inflation up. So we have this flexibility there. So this is a key difference. It's not a flexibility around the point target. It's really that we have the choice to accept different inflation rates depending on the global economic situation.
Okay, that leads to naturally your comments on the role of exchange rate intervention and exchange rate management. So I feel like you're suggesting that you are actually targeting inflation not only through the changing the interest rate, also FX rate is a kind of important variable.
But the exchange rate is a very important variable because it has a big influence on inflation in Switzerland. But we do not target the inflation rate. This is an instrument if it's necessary. So the main instrument is our short-term interest rate. It's called the S&P policy rate. So we operate normally through through the interest rate, as most other central banks do. But in case we have no room of maneuver anymore with the interest rate, and if there is really a deflationary risk because of the exchange rate is too strong, then obviously we have to go to an intervention, to use the forex intervention as a tool in order to bring monetary conditions to an acceptable level so that we do not fall into a deflation.
So recently, I think your intervention on exchange rate is mostly to prevent too high level of appreciation, right? Mostly for the price level. Did you have any experience of actually intervene to protect too much high rapid depreciation?
Actually, we have for a very long time, we had to intervene because of the excessive appreciation of the Swiss franc. That was between the financial crisis and COVID. So that was the period where there was a permanent appreciation pressure on the Swiss franc, at times very heavily overvalued. And then since the end of COVID, where the other central banks increased the interest rates, but especially when inflation went up a lot abroad, then we tried to sell Swiss foreign exchange. So we had a relatively strong nominal appreciation, but that was helpful and protected the Swiss economy from having higher inflation. So inflation in Switzerland never went over 3.5%, but during that time we had roughly a nominal appreciation in the magnitude of the inflation differential. Yeah.
Okay. So the next question is that not just for the FX exchange rate issue, but now we are seeing that monetary policy in major countries start to diverge. We have a quite different stance across important central bank. How you incorporate this divergence of the monetary policy, which will probably emerge more in the near future, how you incorporate into your calculation, estimation of R-star, but also overall monetary policy stance in Swiss. You recently cut your rate, so probably well above others. So can you just comment on how you incorporate this divergent path from now on?
Well, of course, our decisions are really only focused on the inflationary perspective in Switzerland, and we have to make sure that monetary conditions are adequate and that they reflect really the outlook. So I think when the monetary policy in the US and in Europe diverge, they could have a certain impact on the exchange rate, and that could have an impact for us. So it really depends. The Swiss franc vis-à-vis both currency, but when they diverge, that could have an impact on the dollar-euro exchange rate. And of course, that could then also have a certain influence on our effective exchange rate. So we are looking at that very closely. But of course, these are decisions by these central banks in order to get to price stability in the respective currency areas.
Okay. Not now, but during the lunchtime, I want to ask you, when do you expect the ECB or the Fed will cut the rate, okay?
Yeah. I give you a very precise answer.
That's a big issue now here. And then now I think let's move from interest rate issue to some other important issues. We witnessed very successful resolution of Credit Suisse Bank under your leadership in March last year. And can you let us know what lessons we have to learn from Silicon Valley Bank and its spillover to the global banking industry?
Well, the Swiss government just published a long report with an entire series of different lessons and also proposals. Let me concentrate maybe here on liquidity, because for central banks this is very important and relevant. I think what we have learned during this crisis, not only in Switzerland, but also in the US regional banking crisis, is that bank runs can be much bigger and also faster than we experienced so far. So the outflow of liquidity was extreme in a few days. Much more liquidity went out of the bank that previously ever experienced. So I think the lessons from that is we have to look at the funding structure of banks, liquidity coverage ratios, what can make the funding structure more robust against these outflows so that the speed of outflows could be slowed down. It's mainly that banks should look at also at the longer term funding so that not all the liquidity can go out so quickly. And the other is that banks have to prepare more of their assets as collateral that is eligible then for central banks, so that they can bring more collateral to a central bank in order to get the necessary liquidity. And that needs some preparation. So especially that collateral has to be handed over to the central bank. The central bank can or should be able to sell this collateral in case that the loan is not repaid. So all these preparations have to be done so that enough collateral is available. But there will be always situations, extreme situations, where even with the best fund or the most robust funding structure and the best preparation, there might be not enough collateral. And I think this public liquidity backstop is extremely important. So this is now in the Swiss Parliament, and the Swiss Parliament will decide on that. That would then give the Swiss National Bank the possibility to give liquidity without having without receiving collateral, and then that with a backstop, of course, of the government.
Okay, Credit Suisse is a Swiss bank, so in some sense, that policy will be relevant. But what do you think that we have some new view about the ring fencing and or some other policies toward the resolution of the fallen subsidiaries and institutions in your country?
Resolution is absolutely key, and I think the experience that we made now also with Credit Suisse shows that there are some obstacles to resolution, legal issues that were not completely clear, operational issues, and we have to look at that very carefully. So I think there is an absolute necessity that resolution remains a valuable, a possible option in case of a crisis. And so we need to look at that very carefully. This is also one of the lessons in this report of the Swiss government, that we have to make sure that resolution will become more credible and that it can be executed without having the risk that maybe some legal risk will then stop the resolution after it started. So I think these are very important issues. No?
Okay. And my next question is that recently we see not only the interest rate policy divergence, but also the real economy performance divergence between the United States and Europe. And in the United States, the growth is really high, more than we expected. And we also heard that their productivity growth is quite fast. But we usually go to the BIS, many European bankers worry about the slow growth rate in Europe as well as the productivity growth rate. So how do you think that why this difference happens, and how the future economic path of the European economy from there?
Well, this is a very important question. And it's indeed a problem when potential growth in Europe is lower than in the United States. It's not good for the European economists. And Switzerland, we have the biggest trading partner is still the European Union. So for us, this is not optimal if growth in Europe is substantially lower than in the United States. The United States is also a very important trading partner. But I think there are a couple of reasons, and it's not easy to change that at the moment. Of course, Europe suffers also from the war in Ukraine, from energy prices that are higher in Europe than elsewhere. So that puts the European economy at a disadvantage. I believe it's not a problem as long as it's really cyclical. It becomes a problem when it becomes structural, and if it really deviates in the medium to long term. And that, given the proximity that we have with all the European countries, that would be not an easy situation for us as well. So I think we hope that, especially also all the decision in politics in Europe go in a way that potential growth can catch up with other countries, especially the United States. No?
Yeah, sure. Definitely, Europe has also got heterogeneity. Some European countries are doing better. So, okay. So before I open the floor, let me ask you a last question. I think I heard that disappointingly you will be retiring in September, and I'd like to congratulate you on your retirement as you are leaving office, recognized as a great leader in the central banking community. And I would like to ask, what is the most memorable thing during your 12 years so as a chairman of the Swiss National Bank? And if you have any recommendations or messages you would like to leave for the central banking community, we will appreciate.
Well, memorable moments. Well, there are many because we had this long series of shocks. But I think what is really memorable is that we have this extremely good international relationship among central banks. This is really unique. And it's really a very good forum for exchanging views, also but learning from each other. And this is exceptional. So I think in discussions like today, but especially also at the BAS, at the IMF, we have this really good relationship where we can interact very closely and learn from each other. It was also, I think, for me, an extremely good experience going through so many crises that I had the support of all my colleagues at the board, but also the staff at the Swiss National Bank, that we all try to deal with those crises in the same way. So I think that was very memorable and I think very positive for me. Message, this is always difficult. I'm deeply convinced that for the success of monetary policy and central banks, we need independent central banks. But independence can only survive when the mandates remain narrow. So this is something when the broader the mandate becomes, the more difficult it is to explain that to the public why a central bank should be independent. And usually central banks do not have instruments that are effective except for price stability, monetary policies. So I think we should fight for independence. This is not always easy. And we should also then see that the mandate remains narrow, focused really on monetary policy and maintaining price stability.
Thank you. I think you are too young to retire, so I'm sure that you will, even though you deny, you will remain and you will come back to the international banking, in a central bank society or even international community soon. With that, I think we have about 10 minutes. So I would like to ask a question. Oh, Eric. Is a microphone available? Oh, no, we are not prepared. Oh, you can speak up.
Governor Jordan, I want to thank you for what I thought was the clearest explanation of how RSTAR feeds into practical decisions. You mentioned that there were two sources of uncertainty. One was model and the other statistical. And by model, I think what you meant was sort of empirical specification. But I wonder if there's a third source that plays any role in your thinking, which is more conceptual. That, as you pointed out, you define RSTAR as something that will close the output gap over some medium horizon. That seems to imply that there's a U star or a Y star lurking in the background, which then seems to imply that the Phillips curve is central to your thinking. But of course, there are other mechanisms out there that one could imagine. And I'm just wondering whether that third source of uncertainty plays any role in how you think about using RSTAR.
I believe you are completely right. There are many uncertainties, so I concentrated on these two. I think the model uncertainty is also related to what kind of models are usable, are useful. And there's in some specific situations, they just do not really give you a sensible estimate. But you pointed to other variables that are important, and especially in the Swiss case, the exchange rate and the equilibrium exchange rate plays an important role. So also there, we try to have a rough idea where the equilibrium is in order to get a view about the actual stance of monetary policy. Now, the combination of all these variables and where exactly then the stance is a very difficult task, and it's not easy to communicate. Nevertheless, I think for a discussion about monetary policy decisions, I think it's an important duty of our economists to give us some information, how they see the world, and how we can use this information to link it to the inflation outlook and then to a policy decision. So it may be very complicated, but I think the task is really to reduce this complexity to a level that we can have a structured discussion that is at the least possible technical level, but a structured discussion where we can then take the decision. So that this is, I think, the way we structure our discussion when we have policy decisions. So our economists are the experts. They are in charge of these models. They should provide us with this information. Then we should reduce the complexity so that we can figure out whether the policy is correct or incorrect, and then we can adjust. But it's very complex, and you are completely right that there are probably even more uncertainties around that, and it's not always easy to take into account all these uncertainties, especially when they are unknown. No?
Okay. Others?
Thank you. Thanks for a great presentation, a great panel. I was curious to learn a bit more about, sorry, I didn't introduce myself. I'm Carlos Carvalho from PUC-Rio and Capital Investimentos. To learn a bit more about the choice between exchange rate and interest rate as the intervention tool. It's very clear when you are against the zero lower bound and there's an asymmetry, but when there isn't, like in 2022, what kind of things would you look at to say, look, now I'm going to sell some FX rather than hike rates some more? I thought that was kind of interesting. Thank you.
This is a very important point. Well, in fact, in 21, there was this very important discussion whether the increase in inflation was only temporary or more permanent. In Switzerland, inflation was still low, but we observed inflation increasing elsewhere. And the uncertainty was big, but we came to the conclusion that under those circumstances, it may not be a bad idea to let the Swiss franc appreciate, at least in the magnitude of the inflation differential. And we then went in that direction. And so we had more or less a constant real exchange rate, but an appreciating nominal exchange rate. And through that, we had some protection against high inflation from abroad. Not complete, but I think that then led to a different monetary policy stance. In case we had not let the Swiss franc appreciate at that time, and also let the interest rate at the same level, the monetary policy stance would have become much more expansionary, and most likely inflation would have gone up more or less similar than in other countries. So that was a kind of a risk management decision that we took. And then we had over almost 2 years really an appreciation that reflected the inflation differential. And we were in a fortunate situation that we had those foreign exchange reserves accumulated in the past. And it had the positive side effect that we could also reduce the balance sheet, at least to some extent. So we can do that under those circumstances, but of course this is not an instrument that we can apply in every situation. Yeah.
If I just add one, our cases, I think one major concern for your question is whether our exchange rate move together with other countries. Is it a common shock or whether it's our own individual shock that actually affect our choice of interest rate versus exchange rate flexibility. Professor Sargent.
Yeah, this is an old man comment from an old man, and it's very non-technical. Okay, so if you're my age or you read that was a remarkable talk, and this was a remarkable exchange. And I'll tell you what I mean. There was one of John Taylor's conferences at Hoover. He has an annual. Alan Meltzer, before he passed away, he gave a lunch talk about his second volume of his book about the history of the Fed. And he talked about what William McChesney Martin and Arthur Burns, how they described how they thought about the economy and what they were doing. And I was going to say they would have no idea what you two guys are talking about, and you would have no idea what they're talking about. Because, they didn't talk about, look what you're talking about, models, different models, stochastic models, shocks, what's kind of in equilibrium, what's unobserved, what's observed, model uncertainty, not trusting your model, shifting the weights, kind of going beyond basic, all those things, they're very technical, okay? And I think if you kind of look at the outcomes that you and both of you are presiding over, they're much better than the ones that those guys were presiding over. And I think those are connected. So it's just a tremendous amount of progress. Again, this is an old, you don't know what I'm talking about. This is an old man. I just think it's remarkable.
Professor Arjun, I think you have a selection bias.
No.
You haven't asked our press yet.
Wait, and so one more thing. Okay, fine. So there's been a lot of progress. Meanwhile, because Eric's sitting there, what about fiscal authorities? The people, I'm just going to speak for my country only. The discussion of fiscal policy and how it's related to monetary was much more sophisticated by congressmen and presidents in the 1950s. So don't be so optimistic about progress.
Oh. Okay.
A very interesting comment.
It's the beauty of to be a chair. Isn't it?
You are right about the progress in economics. Sometimes you have to be fair with our predecessor. The technology was not available. So at the Swiss National Bank for a very long time used money aggregates. The thinking was more or less the same, but the tools they had, the data was completely different. So it was a different world. So for example, quarterly data in the GDP was introduced only in the 80s or even later in Switzerland. There was no easy models available on computers. So the world was very different. It was very cumbersome to get to these models and results. Today you push on a button. You have a huge literature about everything. You have 40 PhDs that can run these models. That was not the case at that time, at least not at the Swiss National Bank. So I think that is a certain progress, but
One of the reasons there's progress is Switzerland and Karl Brunner.
Yeah.
Sorry.
Yeah. And Alan Meltzer and Karl Brunner. Alan Meltzer came to Switzerland. We have this Karl Brunner lecture and a Karl Brunner conference. So that was a very close relationship with both. Yeah.
But not academic, but I think I agree with you that I strongly believe that if there is any crisis in the future, it's most likely come from fiscal mismanagement rather than monetary mismanagement. Just a Suyang.
Thank you very much for your insightful presentation and then panel discussion with President Rhee. My question is more practical side, given that I'm a new recent member of Monetary Policy Committee here at BOK. And during your talk about Switzerland experience, the estimate of R-star is quite large in terms of the policy decision part, although there is a slow-moving trend. And during that presentation, you mentioned about expertise selection may play a big role. Mm-hmm. So I would like to know more about what exactly experts can add up to in terms of the model selection or the direction of the monetary policy. And in particular, during the period when the business cycle may turn around or new shock comes in, then maybe model may spit out in very different numbers, may or may not be a relevant information we as a decision maker may play in a role. So I would like to know more about some of the details. Thank you.
Well, thank you for this question. I think this is really a crucial task of our economists to figure out what type of models are useful in a specific situation and which models should be discounted. And I made an example before that especially during COVID, we had these large swings in macroeconomic data, and they came to the conclusion that a certain type of model is not useful now for making these estimates. So I think that they have to figure out, given their knowledge, given their expertise in looking at the different drivers, to what extent certain estimates are plausible, helpful, or whether they should discount it. So I think this is not easy, but it's essential. And I think when central bank researchers, in a way, can help us, they can help by interpreting these models, not just believing in the models, but interpreting the models and make the models useful for a structured discussion. So we know all models are by definition wrong, but without models we cannot have a structured discussions. We have to have some views how the world is functioning, where equilibria are, what are the transmission mechanisms, etc. And I think here it's really, this is an art for economists to a little bit abstract from just a pure model to something that is then usable for a policy decision. So it's not that you just see the equations and then the results, but rather than take that and compare it with other things and then say, well, my conviction is that should be more or less something that is useful for as a base for a policy decision. Yeah.
Sorry, I'd like to match Korea precision to Swiss precision. So I know you have many questions, but let's close the session, and I'll pass to the MC.
Thank you very much. It was a very fruitful conversation indeed. Please give them a big round of applause. This concludes the opening session of the 2024 Bank of Korea International Conference. Now we will take a short coffee break and resume the conference at 10:25. We have prepared some snacks and beverages for our dear participants in the lobby, so please help yourself. Please enjoy your break, and I'll see you again at 10:25. 이것으로 2024 한국은행 국제 컨퍼런스의 기조 강연과 정책 대담을 마치겠습니다. 10시 25분까지 휴식 시간을 갖도록 하겠습니다.